Right, hello everyone. Hope you're having a great evening. Come and grab a seat if you haven't already. Alright, welcome to this great event looking at the money moves to make in your 30s and 40s. And of course it's pretty applicable elsewhere as well. I'm Frances Cook. If you've come across my work before, it's probably the Cooking the Books podcast, or you might have come across my book, Tales from a Financial Hot Mess. And if you haven't come across either of those before, then hello. I am a personal finance journalist and author, and I'm going to be looking after you for tonight, along with our great panel. Now, we do have a little bit of formalities before we get started. So we have exits. You can see them marked. If there's the unlikely event of a fire, please take the stairs, not the lift. If there is an earthquake, jump into a doorway or get underneath something, the standard drill, you know how it works. And if you do need to go to the bathroom, then look for someone who's wearing a hatch or a Kernel t-shirt. You do need a swipe to get back in, so do go and talk to them. Don't get stuck outside while we're talking about all the good stuff in here. Okay? So that's it. And I would just like to say before we get started, thank you very much to Hatch and Kernel for putting on this event. And of course to Kiwi Wealth for hosting us. Can we just give them a quick round of applause before we start? Because here's the thing, is that none of us really get told about how money works. Unless you are very lucky that you had parents who understood it, or you had a school that took the initiative. Basically, you get left to figure it out for yourself. And if you're anything like me, then that leaves you feeling like your money just evaporated. You get paid, and then you pay your bills, and then something happens, and then you're kind of broke. Where did it go? Or you might be better than that. You might have a good savings account, and you hear people talking about putting your money to work, and you're thinking, yep, that sounds great, but you don't want to mess it up, because frankly, we all work far too hard for our money to take the risk of something going wrong. And so that's why I love that we get the opportunity to have evenings like this, because you don't want to be treading water and feeling anxious when you can, very often, be doing better with what you already have. And speaking of feeling anxious, I mean, one of the things that's been going around at the moment is that frickin' coronavirus. It's coming for our health, and now it's coming for our wallets too. Great. And I am an investor as well as all the rest of it, and I have looked at my shares recently and just thought, that's interesting. Yeah, exactly. They are on sale. I like how you're thinking. But you know, you might think that I have a plan to deal with this, and the answer is, my plan is to look at it and go, that's interesting, and then carry on with my life, because I was set it up from the beginning to do its thing, that markets go up, markets go down, that's fine. But that's because I was blessed to talk to smart people, and I set it up from the beginning, taking those things into account. And when you have the knowledge, then you'll also have the confidence to look at things like a coronavirus hit and just go, that's interesting, and then focus on things like washing your hands instead of worrying about your investments. You know? So I do think it's really important, before these guys get us into the fun investing stuff, the solid foundation is where most of us need to start. And that's knowing what we want. Because money itself, I don't really care about so much, but money is a tool that can get us the lives we want. And so we have to be prepared to talk about it to each other, and we have to be prepared to decide what actually money can do for us. What do we want? And so whether you are single, or you've got a partner, or you just want to talk to your friends, the best way I've found to start money conversations is time traveling. And one of my favorite things is to go backwards in time to start. And you talk to people about some of their first money memories. And this can be really illuminating, because this is where you see why people feel the way they feel, and how you get some of those money attitudes. And when you do it for yourself, it can lead to a few revelations of, oh, that's why I do that really dumb thing over and over that I know I shouldn't, or that's why I feel anxious about this thing. And you might always feel anxious about that thing, but when you know where it's coming from, you can be a bit more rational in how you handle how you're feeling about things. And then the next one is to go forward in time. And the great one there is to think about what you'd do if you won lotto. I don't know, has anyone here bought a ticket? Come on, own up. Yes, wouldn't it be nice? And even if you haven't, I'm sure you look at that. What's it, 50 million now? It's huge. And I'm sure that makes you think, what would I do if I won it? That's your ideal life. Right there, that's the clarity you need. That's telling you if you want to go traveling, or if you want to help out your family, or if you want to buy your own home and pay it off and have a little corner of this world to call your own. And once you've got the goal, you can work backwards from there and say, I don't need lotto, even if it would be nice. But you can make that happen for yourself. And then after that, it's finding the spare cash to be investing. And I know I get as sick as everyone else does about seeing those coffee articles. Cut out coffee, you are peeing money down the drain. Rude. The biggest expenses for most of us are housing, transport, and food. And if you can save $200 on your rent, that is so much better than saving $5 on coffee. So the biggest one is always to start with your big expenses. And if you can cut back there, that will be so much better, because you're also not having to make lots of small decisions every day. Decision fatigue is real. So if you can make a big decision, one and done, change something and lock it in, that's going to be so powerful for your money. And then the next one, in terms of money management rather than budgeting, because who doesn't hate the word budgeting? But if you're managing your money, you are making it do things for you. So I love this advice, is the idea of keeping a money diary. Even if it's just for a week, and you write down everything you spend for a week, and how happy it made you and how much you needed it. Because I would hate to see people cutting out the things that make them happy. Those are often the things we think about first. They're often right in front of us. But there is almost always a few things in that money diary that you neither need or make you happy. And so those are the things that you cut first. And once you've got that groundwork sorted, you've got your motivation, because you know what your ideal life looks like. And you've got some spare cash sorted because you've cut out the things that aren't serving you. Then you can start investing and building towards this goal and what you want your life to look like. And it's always, if it starts getting frustrating and you're thinking, I can't make this happen, it's always back to those core concepts of what are my goals, what makes me happy, what doesn't make me happy, how can I be smarter with my big expenses, never mind the small ones. And then you can get into the fun stuff, like investing. So, let's get into that fun stuff. And we will start with, oh wow, I didn't look at my notes at all, I'm way ahead. I got too excited talking to you guys. So, we have Kristen Lunman from Hatch. And Kristen is no stranger to New Zealand's startup ecosystem. She loves working with digital disruptors, firm believer that technology should simplify our financial lives, and of course is working on that as the GM of Hatch. So now she is going to give you her top tips. Thanks so much. I'll take that one. Thanks everyone so much for coming. Hope you like our space. We moved in at Christmas time, and just getting this, you're breaking in our event space, so that's super cool. Thanks for taking the time out to learn about money. We will probably be fairly broad with our top tips, so please take advantage of Slido. Did we talk about Slido? I did not tell you about Slido. If you have questions, we will have questions at the end. So we will, of course, be talking to you guys in our audience, but for those who are at home, it's Slido, sli.do, and you can log in with #MoneyMovesWellington. So keep those burning questions in mind. We're going to have a lot of time for them. Yep. So as we're talking generally and tips for your 30s and 40s and other ages as well, of course, anything specific, throw it into Slido, or I'm sure we'll take hands up at the end as well. So I'm going to start with a few tips. The first being, if you're not invested in the share markets, start today. or at least start learning about how to do it today. Why? The share markets have been historically one of the best ways to grow your money and to grow your wealth. So it's absolutely, if you're in KiwiSaver, you're already investing, and that's invested in the share markets. And so you as an individual investor can do it outside of KiwiSaver. So I just want to give you a few quick tips. So the first is invest, start today. How might you do that? Investing your financial literacy. So find your place to learn about money, where you feel comfortable, where you feel like it speaks to you. And so you could start with, Hatch has an investing course, the Getting Started course. You can Google that. That takes you through 10 days of what is risk, what is the share markets, right through to being an actual investor. You can look at that. Other favorites we have is a newsletter, a daily newsletter called Finimize. You can look at Morning Brew. You can sign up to, take a look at The Balance. That's a website that we love. Motley Fool for slightly more advanced investors. Seeking Alpha. Endless podcasts, YouTubers. Look, there is a place for you to learn about money that you kind of feel like, this speaks to me, I understand it, I feel at home, and to find your community. So get started today, investing your financial literacy is my first tip. The second one is a very common investing strategy. So now you've empowered yourself, you're going to start investing. An easy way to start is to start broad, then go narrow. So start thinking about what are some, so starting broad basically means take a look at some exchange traded funds or funds that are really broad based and they cover a lot of the share markets. So on Hatch we've got a couple of really popular exchange traded funds that cover huge swaths of the markets, and what that means is diversification. So you're not invested in just one thing, but a bucket. It allows you to place a single trade, but be exposed to hundreds of companies. And so that's just a fund that is listed on an exchange, hence the name exchange traded funds. So some really popular ones would be the Vanguard Total Market that exposes you to over 3,000 companies on the US share market. So really broad based and just tracks, the success of those companies. So if one of those companies does really poorly, you've got 2,999 others to count on to do well, and they tend to balance each other out. There's an international stock market fund, the Vanguard Total International Index fund, and that covers the whole world. So I mean, you're probably pretty safe to have a really wild. There's 3,000 non-US shares in that one, so really well diversified. And then let's talk about going narrow, and that is starting to invest in things that might generate higher returns. So that means less diversification, but it also potentially means higher returns. So this means a little bit riskier as well, could be a little bit more volatile. So that's anything from a very specific fund, let's say one that is really pure tech focused, one that might be retail, consumer goods, right down to individual companies. So start broad and then go narrow, and think about, what do you know? What companies do you know if you're thinking about investing in companies? Think about the brands that you use every day, that your colleagues use every day. These are things you're already investing in, and companies that you're backing in. Think about the future you believe in. Is that green? Is that cannabis? Is that electric? What is it where you can start to kind of have fun with your investing? You've got your core broad stuff. Where can you start to actually say, I'm backing the future of this company and I want to benefit from the success of it? Some of the most popular shares on Hatch are probably no surprise to you. They're the big tech, they're the big FANG companies. So we've got Facebooks and Apples, Amazons, Googles. These are companies that people are really backing to be around and really transform this world and be really valuable in 10 years' time. Tesla is also a really popular one as well, and people are backing the vision of that company. Netflix, Disney, again, these are companies that you're using every day, and you can actually start to play a little bit with your portfolios to have something that reflects who you are, and tilt it to things that you care about. Start broad, go narrow. And my last tip is, actually, to be fair, Francis has covered it a bit, and it's ride the wave. If anyone is already investing, probably saw a lot of red this week, which was scary for some. And really it's about, investing is one of the times where it kind of pays to be lazy, and just pays to be, just be cool-headed about it, and recognize, if you look at history and the share markets, they've returned on average 10% a year. So it's a pretty interesting place to have your money. That's averaged over, I think that's 79 years. But if you look at 2008, global financial crisis, you would have lost 30% that year. If you look at last year, 2019, stellar year, you would have been up 30%. So these things tend to balance out. Peaks tend to outweigh the valleys, and it's certainly a great place to grow your money is in the share markets. So ride out the waves, don't panic, and naturally we're also seeing more sophisticated and more confident investors looking for sales. I think I heard that. So you're looking at, the market's doing something weird, everyone's freaking out, but I back the fundamentals of this business. They're making money or they're growing in customers. The business is doing well, so that share might just happen to be, that stock is on sale. And so that might be, a strategy that investors are employing this week and that we're seeing. So again, top tips is find your community with financial literacy. Start today. Second, think broad, get really well-diversified core, kind of set and forget, continue to build that little bucket, but then start to really have some fun with your investing and back some of the some of the sectors or companies that you believe in, and that really empowers you as an investor. And the final one being just ride the waves, because they're gonna come. We're gonna have, a shock this year, a shock next year, in 5 years' time. Those are all part of normal, investing lifestyle. But in your Thursday and 40s, we've got lots of time, to ride those waves and come out at the other end. Thank you.
Cool.
Beautiful, and so agree there as well. Like the passive investing, the lazy way, that is just, it seems counterintuitive, right? But it is how it has been proven over and over again the best way to make money. So thank you so much for that. Now, next up, Tom Hartmann, waiting to go. He's the managing editor at a place that you might have heard by a few different names. It's Sorted, CFFC, or the Commission for Financial Capability. His focus is helping New Zealanders prepare for their financial future, continually developing the sorted ecosystem of websites, tools, programs, publishing to lift financial capability in schools, workplaces, and communities.
Cool, thanks, Francis. Hi everyone. So I'm hoping that many of you will be familiar with the Sorted website. We've got lots of what may be not so well known is how much we have on there for investor education. Actually, and if any of you have heard of the Smart Investor website that went live last year, just about a year ago, it's a great place. It's a comparison engine to compare KiwiSaver funds, managed funds outside of KiwiSaver, share offers and bond offers here in New Zealand. Just a couple of tips. If you're thinking about, well, how can I invest more? Essentially what we're after on Sorted is goal-based investing. And what I always like to see is people using financial products that help them achieve their goals, whether it's insurance, whether it's investment, any of these things. And one of the things that I wanted to mention is not so long ago I got ambushed by a journalist. It wasn't Francis. It was someone asking me right at the beginning of an interview, okay, so what do we need to do to get rich? Right away. And I was like, luckily, I was able to say, well, you know what? You are already. And the reason why I said this is one of my favorite things to do is take time out of the equation. So I have a little job for you, or a little exercise if you want to make this a little bit interactive, is whip out your phones. Let's do a quick calculation. If you take your income over a given year, and Darcy was quick to point out that this should be after tax if you can do that, if you have it handy, figure out what you make in a year and how many years there are until you retire. What does that work out to be? Do it right now as we're talking. Because when you think about it, in terms of the money that you'll invest, that's probably where most of it's going to come from. And as you put it, it's a little bit daunting because you're like, oh, that's how many paychecks I have left, or that's how many years I have left, and it doesn't sound like a lot. But if you look at the financial value of that, it's huge. I can pretty much say for everybody in this room, and that's only using what you're currently earning. You're all going to have spectacular careers. It's not going to stay static, and especially if you're interested in investing here, it's all about growth. You're going to get to a better position. That's what investing is all about. But at Sorted, we'd like it to be really tied to what you'd like to achieve, as opposed to what everyone else wants to achieve with your money. So there's this little thing called paying yourself first that I go on and on about, even on national TV. And it's really, if you think about why the tax system works, why KiwiSaver works, it's pretty much you're squirreling away that money. If you did that calculation, you would see that actually, if you did that for yourself, you'd be able to have a funnel of money that you could use in different ways for your goals. And one of them could be towards investing. And we're always on about setting goals for short term, which is really easy for people, medium term, which is a bit harder, and long term, which is quite difficult for people in general to think about, 10-year, 20-year, or as you know, Sorted is put out by the Retirement Commissioner, planning for retirement, which could be, 30 or 40 years away, or even less. Even planning 20 years, goals for 20 years is not easy. So we've put together a bunch of tools on Sorted to help people really get their, whether it's KiwiSaver investing or investing in general, really aligned towards your goals. So just a couple things with KiwiSaver. We've got lots of tools on site to help make KiwiSaver decisions. KiwiSaver is really only good for 2 goals, right? It's really only made for 2 goals. It's either you're preparing for retirement or using it for a first home. So if you have goals that are outside of KiwiSaver, you need to be looking, that are outside of those 2 things, you need to be looking for products that really align with that. What's a good thing to use, for example, if you're, investing for your favorite classic car, or investing for your kids' education, whatever it is, you're looking for financial products that really align with that. The other thing that I'll say, the other thing that I'll say is we're after people to get strategic with their investing. Lots of times in these, I'm really impressed with all the new platforms that are out in terms of investing in shares. But before that, there's a really good question to ask is how much of what you hold should be shares? That's a really strategic choice. So what that's about is, many of you'll know about strategic asset allocation, this investment mix that you're meant to hold. That's what drives not only your results, but your experience of the ups and downs in the market. But that is a key strategic decision on whether you'll be on track for your goals or not. So a little bit of some questions to answer for yourself as you start to set goals for what your investing is for. The final thing I'll say is just about risk. And the best definition that I've heard for what risk is about, especially regarding investing, is risk is the chance that you might not reach your goals. So it turns out there's actually lots of risks that come with investing. But if you keep it very goals-based, you can see what those are. And if you think of investing as a vehicle, where is it going? Where do you want it to go? And where are the potholes? Where are the accidents? Where is the traffic? And those are the risks you're running, and then you need to find other ways, but always to get to your goal. So I wish you well with your investing, that it's all on track for you to hit the goals that you want, not those that somebody else chooses for you. Cheers.
Wonderful. Thank you so much, Tom. And I must say, if you haven't looked at the Sorted website yet, it's fabulous. I love the calculators there. You make it so easy. All right, Dean Anderson up next from Kernel. Dean aims to help ambitious, people reach financial freedom, which is, pretty great. But he does it through creating innovative financial products. He had 5 years as the head of product at SmartShares, so he knows index funds inside and out, but wanted a fresh approach, so he left and created Kernel, which is an index fund manager with a digital wealth platform. Thanks, Dean.
Thanks, Francis. So obviously I'm Dean. We are Kernel. We run a range of index funds. So just a quick definition of that. Basically, that means we don't go out there and hire expensive analysts and try and pick stocks to go into the fund. We simply buy and hold companies in the same weighting that they're represented in a given index. And that index is whatever it is that fund specifically tracks. We are very passionate about index funds because, as a couple of people sort of touched on, it gives you broad diversification. It's a really easy way to get started with even a small amount of money to get spread across a number of stocks. And comparative to high fee active management, consistent research shows that over the long term, it's very hard for those active managers to outperform just buying a given index. So a couple of tips from me. It's sort of been touched on is the whole getting started and investing towards your goals and what's your risk. So around that, really the most critical question that you need to ask yourself is, when do you need the money? So you'll be investing towards a goal. When do you need that money? Maybe the goal is for that first home, maybe it is for retirement. That goes into that risk question and strategic asset allocation. How much do you need to have in equities versus how much in fixed income, cash? Obviously, the shorter time period that is, the sooner you need the money. You don't want to be fully exposed to the ups and downs of the share market. But over the long term, that's where you need to be invested, because that's going to give you the greatest chance of the greatest return. So on that, I guess it's looking around the room, and obviously the theme of tonight, it's really important to remember that you're young, you have a long time period in front of you, so you may have multiple goals. One of those may be retirement. A lot of you won't even be at your peak earning period yet, so you have capacity to ride those ups and downs of the market. The big thing on that then is shutting out and ignoring the headlines. Think about your objective. If your objective in your own personal situation hasn't changed, don't go making unnecessary changes to how you're investing. A great little example of that was a stat that we were looking at the other day. 20 years leading up to the start of 2018 in the US market. There's about 5,000 trading days over that period, and you would have averaged about 7.2% over 20 years. Great return, better than what you're going to get in fixed income. If you missed 5 of those best performing days, your return would have been 45% less. So missing 5 days, you're nearly half the amount of returns that you would have had. So that's a really key message there, that yes, there are ups and downs, but ignore it. Be in the market, get started, and think about your long-term objectives and when you need the money. Because if you're in and out and you're trying to time things and you're trying to guess whether the market's up or down tomorrow based on all the scenarios that are going out there, good luck. All the research shows, active managers, everybody else, you can't do it. So just think about that long-term goal, what your objective is, and when do you need the money. Feeding into that, the other big one is a common thing that probably most of you are familiar with is dollar cost averaging. Dollar cost averaging, and probably very relevant for the audience here, you've probably got a leftover disposable income. This is the pay yourself first mantra. Put a little bit away each month. Don't worry about what the prices are, just set your objective, how you want to invest, and just keep regularly putting into the market. Again, we did a great blog on this, actually looking at the real data of the New Zealand market, and we compared that to somebody that tried to time the market and time the bottoms and the tops versus somebody that just put $100 in every week and forgot about it. It's completely stress-free. The guy that just put $100 a week away into the market outperformed over 20 years the person who perfectly timed the bottom every time. So it really is that whole thing of get started, stay in the market, and invest towards your long-term goal. It is actually that easy. The final thing I want to talk about, and it's been touched on, is core satellite. So for us, obviously, we're really passionate about index funds, and it's really important when you're investing to make sure that you've got appropriate diversification. You don't want to go and put all your money into one single thing. That is quite risky. Maybe that is your game. But for a really good outcome over the long term, get that diversification. Start with a broad fund that's going to give you exposure to the market, and that's going to give you that long-term trend of the market return. That's your core. Outside of that, you have what's called satellites. That can be your fund money, your strategic plays, and that can be whether through picking individual securities, or you want to back a company that you know a lot about. It may be an investment property, whatever it may be. Those are your side plays, and that's not all of your money, but it's the things that may give you a chance of achieving above average returns, but you're not risking everything on that one sort of higher risk strategy. So I guess the 3 key things there are, when do you need the money? That sets how much you want to be in equity markets versus fixed income. Think about the fact that you do have typically a long-term horizon in front of you. Start putting that money into the market, ride the long-term trend of that, and then if you want to start advancing your investment strategy over time, think about that core satellite approach.
I love that. It's so true. Time is literally everything when it comes to investing, and it's how you choose where your money's going, it's how you make your money, it is absolutely everything. So don't try to time things, just give yourself lots of time. Thank you, Dean. All right, up next we have a fellow podcaster. It's Darcy Ungaro. Now, he is a self-employed accredited financial advisor for over 17 years, and on top of investing in property, Bitcoin and shares, he's the host of the New Zealand Everyday Investor, talking about everything related to building wealth. So welcome very much, Darcy.
Thank you. Thank you, Francis. I learned something really cool tonight. Something to do about a window. What was it called again?
Oh, Overton window.
The Overton window. Who knows about the Overton window? Wow, it's just Francis.
Political nerds. I thought it would be all about it.
Yeah, but it's something to do about a window and I don't even know. What's it called again? Because I'm going to use it.
Well, now I really hope that I'm getting it right, because I haven't Googled it. We were just chatting before.
Yeah.
It's the idea of you have a vague idea of what's normal, and then if you get a radical over here, they shift the idea of what's normal. They shift the middle ground, also known as your Overton window. Happens a lot in politics, America, but can also happen in other places too.
Cool, thank you. Perfect. So I'm kind of like that in terms of how I work. So I will be to you like an Overton window sometimes. Is that right? Is that the way I'm saying it? Okay, cool. So I'm a financial advisor, and I'm not all about tips and tricks and best practices. Let's just put it that way. I do like to say things that are sometimes a little bit aggravating to my clients to get them to get more towards what should be normal for them. You like that? So that's what I do, right? So I sit down with people. Generally speaking, I work in the area of stuff with property. So your own home, investment properties, moving more towards investments. But that's kind of my sweet spot, is dealing with people who want to own property, who do own property, who want to own more property. I'm aware that it's not necessarily what's right for everybody, but for a lot of us in this room, it would be great if you own property. So I don't know, but I'm curious. How many of you guys actually own property? That's a lot. Okay, well done. Keep it up. And it's not like, hey, you guys are the winners and everybody else are losers, but it would be great if we could all own property. I love it. I think it's great. Roughly speaking, you got 4 asset classes: cash, fixed interest, property, and shares. Shares is the spicy one. Property is a little bit more mellow. Actually, you have alternatives as well, which I'm a fan of, but we won't go there. Property, a little bit more mellow. We use leverage, bank financing, mortgages to amplify the gains with property. So I love leverage. I think it's great. We should all be soaking in it. It's beautiful stuff. It's great for your skin. But I just want to briefly talk about 3 things that we talk about often, or that I talk about often with my clients. Not tips and tricks, just themes that I find myself talking about. Number 1, buy your future home for the future you at today's price. Buying the future home for the future you at today's price. The faster you can buy the home that you're ultimately yearning to be in, the better it will be for you, because then you'll avoid this thing called property inflation, and you'll avoid this thing called renovations, which if you're from Auckland, it's hell on earth. You don't want to go there. You will pay more for the home that you ultimately want if you don't get it right away, because of this thing called property inflation. So that's the number 1 thing. Buy the future home for the future you at today's price. Number 2, don't wait for conditions to be right, or else you'll never get anything done. And this is kind of like that whole concept of time in versus timing that these guys have been talking about already. Like with shares, don't be a stock picker. Just get in. Just get in. If you're looking to buy a home, you people that didn't raise your hands, if you think you might want to do that, do it as soon as you can. And if you're thinking about upgrading your home because you know it's too small and you're going to have to either renovate it or sell it at some stage, do it right now. Don't screw around. It's just going to be more expensive later on. Don't wait for things to be right. Don't wait for the market to crash. You're not going to pick it. Just get into it, get it done. Don't overanalyze it, but don't be lazy either, right? Somewhere in the middle. Okay, last thing. Don't deleverage too soon, and don't avoid debt, which sounds really spicy, especially if there's any of you militant money mustachians out there. No offense. I love you guys. You're different. But people often will deleverage too soon because they believe that's actually the goal, is to get out of debt. It's a very finite journey between here and having no debt. You're never really going to save yourself wealthy. there's a lot of power, especially if you're young. Remember, 30 and 40s, that's the name of the game here. There's a lot of power in using other people's money to build wealth. And we do that by acquiring assets as fast as we can that are growing in value. So don't deleverage too soon. Don't make this all about getting rid of debt too soon, because the things that you can buy with debt will be the things that will get you there. Cool? So those are 3 things. They're not hot tips and tricks. Those are just 3 themes that I often talk about. Cool?
Cool.
Offended yet?
I do like, this might be the last time you and I agree all evening, but I do like the point of the perfect being the enemy of the good. And it's so true. You hear people saying, should I buy in now? It's, the market's going down. Do you think it'll go down further? Should I buy in now? Just when it's the right time for your finances and you know your goals, that's the right time. So we'll have the Slido thing. Woohoo! Thank you. From my lovely assistant. I would like to start, I'll check out the Slido questions while you guys are answering, but I would like to just go down the line, and I'll hand you this once I'm done. What is something that you get a question from people all the time, and what's your answer? Well, being Hatch in the US share market says, how do I get started? And so I would say start today and start with a small amount. Probably if you were to say throw $500 into a company that you really believe in, that you see everyone using, do it. Watch that company and share price over the period of 6 months. You watch it go up, you watch it go down, and you start to tie these world events or stuff that's happening with a company to what's happening with the share price, which is really interesting, and probably the best financial investment that you can make in your literacy is actually fundamentally understanding why something might go up and why something might go down, rather than spending lots of money on any financial courses or anything. It's just really just get into it. Anyone can learn. How do I get started? Just get started with a little bit of money, chalk it up to education.
I get asked a lot about fees, and I get asked a lot about why they matter, how they matter, and I've come to the conclusion that a lot of people don't understand fees when it comes to investing a lot. But they also don't understand when we put out returns after fees, why that number is way more important. But in investing, you don't necessarily get what you pay for. You would think if you're buying a car that you would actually, when you pay more, you get a higher quality car. Very often that might not be the case, which is why you have lots of different philosophies. But pretty much returns, when we're comparing them, it's always something that's in the past, something that's already gone. With fees, they're actually predictable going forward, and that's why we have this overemphasis on fees. Sometimes it's too much, but they're actually something that we can control. So it's good to have a look at them, because obviously they eat away at our results, but the really important numbers are those results and how much we're growing going forward. So it's sort of an interesting balance, value for money, et cetera, et cetera. Thank you.
I guess I want to reinforce that point. As an index fund manager, there is a lot of emphasis in the New Zealand market on fees of a fund. And I think partly that's that we're still a little bit behind in our sort of financial literacy here. You guys are clearly ahead of the game, the fact you're in this room. But there is still this focus in the market on just fees, and I think there is a shift as we start to evolve and financial literacy grows, that we are looking at the other things, because there are a lot of other costs outside of just the management fee. Particularly when it comes to an index fund, the index matters most as well. Not every index is the same. They'll perform different in different markets. So you really want to start to do your research, dig a bit deeper, and understand what are the big drivers of it here. What am I investing in? The idea of just chasing the lowest fee product doesn't necessarily always mean the best. It is something you can control, but you've got to look at that big picture. And I guess quickly, just also on that, probably want to just demystify one thing. I used to be involved with exchange traded funds, and so ETFs are a common thing, particularly in the Mustachians group, and a term. Clarifying quickly that ETF does not equal index fund. So a big confusion here is that people think exchange traded funds or ETFs are index funds. Not the case. Exchange traded funds, the ETF, simply means the units in that fund can be bought and sold on a stock exchange. They can be active, passive, could be leveraged, could be anything. The strategy of the fund itself has got nothing to do with the fact that it's an ETF. So again, that comes down to making sure you know what you're investing in and digging a little bit deeper and doing your research, because if you want an index fund, don't necessarily just buy an ETF, because you could be buying an active ETF, so you do need to actually do a little bit of homework.
That's good. I learn something new every time. That's cool.
Are you going to action on it?
No, probably not. I totally forgot the question. Sorry, Francis. What was the question?
What do people ask you all the time?
Yeah, thank you. Okay, so one of the common things are, and I guess this comes down to the fact that often when we're asking questions, we just want a simple yes or no answer, but often the real answer is outside of a yes or no, if you know what I mean. Sometimes you actually need to be told something that you haven't actually already thought about. You know what I mean? So sometimes when people ask me questions, I give them a little bit too much, but I'm answering what really needs to be answered. So as an example, when people ask me, what should I be doing? Should I be paying off my mortgage faster, or should I be investing? There's a lot in that, because you can't just say, hey, this is the answer. There is no answer to that. It all depends on who you are, what stage of your investing life cycle stage you're at, what your attitude towards risk is. It depends on a whole range of things. And it's something that I get asked all the time. So typically, say there's a young couple, they've got a mortgage, and they believe that they need to be getting rid of that debt, and that's fine. So they get rid of that debt. There's a couple of different ways that we can restructure their mortgage to help facilitate that, or we can just increase the payments. It's a real simple solution. But the question is would they be better to increase their KiwiSaver payments, or get into a different fund, like, do investing outside of KiwiSaver, lower fees, all the rest of it? The question becomes, the issue is what's the rate of return on your money that you're sending off into your mortgage? And if you have nothing else to do with your money and you're very, very conservative, yeah, go for it. Fill your boots, repay your mortgage real fast. But all you're really getting is a very risk-free, well, it's basically a risk-free rate of return, right? Because you're not taking any risk when you're getting rid of debt. So that's all you're getting. It's a very low risk-free rate of return, especially right now with interest rates dropping. So there'll always be that gap between that risk-free rate of return by repaying your mortgage and putting it into something else, anything else. But if you're young, consider something with a bit of growth behind it. So again, goes back to that other theme. Should you be getting rid of debt fast, or should you be soaking in debt for a little bit longer? There'll be time in the future to get rid of debt, but now is the time to hold assets as much as you can, and that means investing at the same time as being in debt. So that's it. That's one of the questions. Yeah. Cool.
What's happening? I keep agreeing with you.
Really? Something strange is happening. It's the Overton window.
I was going to say, you've moved my Overton window. Okay, is there anyone in the audience who has a question? No? Should I go straight to Slido? Oh, at the back, go for it.
So, can we just talk a bit more about that ETFs and index funds? Yeah.
Okay, the question for those at home is, can we get a little bit more on ETFs versus index funds?
Is there something specific, or?
So you said that if you're investing in an ETF, let's say NZ Top 50, which is on smart shares, is that tracking the NZ index?
Yeah, correct. Yeah. So in that scenario, that product is an index ETF, but you can have active. For example, the fixed income ETFs in New Zealand are actively managed. They're not index tracking. So it may be an NZ bond ETF, but that's not an index tracking product. It is still an ETF, but not index tracking. So big definition there is think of ETF as just a doorway. You've got a couple of ways that you can get into funds. Unlisted, like what we are at Kernel, where you can buy units or sell units directly from us, the manager, or an exchange traded fund where the units in the fund can be bought or sold on the market. There are pros and cons of both. We'd argue that our model is better in New Zealand, and that's driven by a number of factors like trading costs and other things. So there are a few things that you need to consider, but generally speaking, you just need to understand that an ETF doesn't mean that it's an index fund. An index fund or an active fund, that's the strategy. An ETF is a doorway, same like going in an unlisted, it's how you get into that product.
So when you have an ETF which is not tracking index, that pretty much is like a pool of companies?
Yeah, it could be, exactly. It could be just like any other active fund manager. It just happens that they've gone and put those units in that fund so that they're on the stock exchange so somebody can buy and sell them. So it's just that access mechanism. And like I said, there are pros and cons of both of that. Obviously introduces fees around trading costs and other things, but it's a mechanism basically.
And the great thing as well is that anytime you're looking at investing, there will be product disclosure, and it will tell you active, passive, here are the fees, here is whatever else.
Yeah.
So
Yeah.
just look for those terms. All right, cool. We're going to go to Slido. Darcy, you've got everyone talking about leverage, and they want to know if they should. I know, but now we're going to disagree. So we've got a lot of people asking, should you leverage into shares? When should you leverage into shares? How should you leverage into shares? Now, I'm going to jump in and put out my 2 cents, and this is...
Thank you.
I mean, a lot of this is... We've got to remember that this is all general chat, right? We can't talk to people's personal situation because we'd have to go through your accounts and have a proper sit-down chat. But... And also, most of us aren't qualified financial advisors. There's that too. But... My 2 cents and my point of view on this as someone who's looked at personal finance is I would only ever use leverage on property. Leverage and using debt for shares is a technique for experts, and it's one that can go really wrong, and some people do it great, and some people get bitten by fire on it. So there might be a different point of view. I'd love to hear Darcy's.
No, I'm not going to deviate from that too much, trust me. Actually, I'll tell you a little bit of a story if that's cool. So there are CFD, cash flow derivative trading platforms out there, and it's as close to gambling as you can possibly get in the investing world. I won't go into too much detail about what it is because I don't want you to do it, but that effectively uses leverage, very high amounts of leverage, to place trades, short-term trades where you make a gain on it, ideally, but you never do. You lose every single time, which speaks exactly back to what Dean was saying around don't try to outsmart and outperform the market because you're just going to get nailed, and leverage will just amplify the hell out of it. So ideally, don't use leverage with shares, but you might want to do that. I don't know. It depends on how spicy you are, right? There are a couple of different ways. You can get a margin account. A lot of brokers will have that facility. You could just buy shares in companies, I guess, that use leverage. You could get into unlisted property funds, for example, that have leverage applied, usually 40-50% leverage on unlisted property funds. That's not uncommon. Or you could just top up your mortgage and tip it into your share trading account, and off you go, fill your boots. So it's totally possible. But again, thinking about those 4 asset classes and the crazy monkeys in the tree, the alternative assets, cash, fixed interest, property, shares. Shares very volatile. That's why leverage is normally applied to property, because it's a little bit more spicy in terms of its action, and we're amplifying those gains. Fairly safe, but you can still lose. But with shares, very, very risky. The faster you go, the bigger the mess. So I would advise extreme caution. It appeals to the certain sort of person amongst us who are very much about winning and ego and trying to outsmart the market, and you're just going to get nailed. That's my 2 bits anyway.
Probably just quickly clarify that though. I'd argue back that not paying off your mortgages quick and investing outside of paying off your mortgage is actually leveraging into the market. You pretty much are just not, you're borrowing against the house by choosing not to pay it down as quick. That is leverage. And as Darcy touched on before, why you would do that? Because A, it gives you something that's really accessible when you need it and it aligns with another goal. The other thing to think about is that historically, over the long term, equally, share prices do outperform, the market does outperform property. And so again, if the expected return over the long term is greater than what you're paying on your mortgage, that is a form of leverage, and it is investing into the shares on the back of leverage. So,
excellent. All right, and there's another one that I'm going to send Tom's way first. And the question is, when should I not self-manage? When should I get financial advice? And I'm also going to add into that, how can people find good financial advisors?
One of my favorite places, actually, I hope nobody minds that I say this, is not unsorted. It's on Mary Holmes' website. She's got a page there where basically she lists a lot of financial advisors, and if you're shopping around for one, I highly recommend it. I'm sure she won't mind. I say this. Good, in general, good advice is gold, right? But in order to find it, that's the trick. So we really, unsorted, we say shop around, get a good fit. Go talk to people like Darcy and then a few others, and not just Darcy, and make sure that that you have someone that you can work with. Communication is good. That they know what they're doing. They have a level of expertise, and really you're able to do something together. However, if it's not good advice, you can get steered down a really wrong track and end up somewhere where you don't want to be.
Do you think it's possible to DIY successfully?
Oh yeah, I mean, a lot of people, if they, it depends a little bit on your personality too, that you're putting in the time to do research. I mean, that's one of the reasons why we built a lot of the comparison sites on Sorted, is for people who really do a lot of research. Traditionally, there's been this sort of asymmetry of information between the expert advisor and the everyday investor. And in order to equalize that out, we've been publishing and the disclosures and taking all the data. The data is much better these days, and so you can actually inform yourself a lot better and have a much more informed conversation with an advisor. It's one of the reasons why we put together the resources on Sorted.
All right, I'd like to open it up again to the audience. Has anything sparked questions, feelings? Want to have a rant? Please don't have a rant. No? All right, well, what about in terms of KiwiSaver? Because there are questions coming through on this, because we've talked a little bit about active and passive and all that stuff. And of course, KiwiSaver is most people's start on investing. So this question actually came through and it said, Darcy, how do you feel about managed KiwiSavers? How do you feel?
Yeah, well, that's a good question. I might need. What I do like. So what do you? Sorry, just to specify a little bit. Managed as in.
I'm assuming they're meaning active.
Right, active versus passive in terms of style.
Yeah, I think
Yeah,
so.
cool. Okay, I'll have a crack. Wait.
It's more using cranks.
Yeah, Craig's,
So
yeah.
self-managed KiwiSaver.
Fantastic.
Oh, there you go.
Yeah, awesome. I personally use Craig's, and I have selected my own scheme within there, and so I'm a fan of it. Clearly, don't do what I say, do what I do. It all comes down to how smart you think you are relative to the market, right? So if you can pick it, sweet, go for it, right? But I personally believe that in some cases you just got to trust somebody at some stage to actually make some investment decisions on your behalf. And so, yeah, that's pretty much all I got to say about that. I'm not really all over that so much with you.
I'll give you a quick stat just to probably emphasize, given the age of the room. Over a 40-year period in the US market, 12 of 500 stocks outperformed the 500. That is your chance of beating the market if you're investing for 30 or 40 years. And that is what you're doing with your KiwiSaver if you've already bought your own home. So really be careful about what you think you can achieve personally. And honestly, if that is that long-term allocation, take an honest look at your returns and benchmark it. Really benchmark it against you would have got elsewhere. But the benefit of those platforms like that is you can do things like core satellite. That still can apply in KiwiSaver. But I guess the big point is don't just pick one or two stocks for a 40-year KiwiSaver investment plan. Make sure you've got that broad exposure still, and then start doing that if that's what you really want to do. But remembering that only 12 out of 500 actually beat the market return over that sort of 30, 40-year period.
So this brings us into diversification, really, and a lot of the questions I get, particularly about KiwiSaver, is about that strategic allocation and the mix between fixed interest and, say, shares and the proportions of which. But there we're not really talking about diversification. I really help people to look a level below, really on the asset level, on the individual investments that are in that share bucket, that are in that fixed interest bucket, and to make sure that there's a range of industries, that there's a range of locations in order to be safe with our investing, make sure that not all our eggs are going in the same basket, that if something goes over, some are going to do well, some are going to do less than well, and they're going to sort of soften the hard falls that there can be.
All right, well, the next one I'm going to send your way, Kristen. There's a question come through, will Hatch offer company accounts? And I'd also like to add to that, is there anything that you see Hatch offering coming up new in the next few years?
So company accounts being business accounts, probably not our focus at the moment, but we're definitely looking at kids accounts. So we recognize kids and joint accounts are how families operate, so that's something that we are looking at. on the horizon. I think, yeah, I mean, personally, I invest in Hatch on behalf of my kids, and it's a really cool way to engage them in, again, shares that they know and love. So my son is Nike and Apple, and my daughter is Netflix and Disney and other things. So I think that's a fantastic way for kids to learn investing. So that's something that's on the horizon so that they can get their own little Hatch accounts. In terms of future stuff, we love the core satellite approach as well, so we just want to make that easier. I think, again, a lot of people, if you're to start with Hatch, probably need a fair bit of confidence to kind of build your own portfolio. You can start small, that's great, but we're just going to make that a lot easier as well. So those are some new things coming on the horizon.
Cool. All right, what about you, Dean? Is there anything that Kernel's looking at in the next couple of years that you guys want to bring in?
Years is actually a long time. As a startup, we're 6 months old, and so even 3 months is a long horizon for us. We are very busy. I can say that there's a lot that's going to happen over this remainder of the year. We've started with 3 funds and our platform, and so yeah, there's a lot of things that we're exploring that we will be bringing to the market. So I guess just follow our newsletter and see what happens.
Exciting, mysterious. All right, Tom, I'd like to send this one your way, and this is a great question. Thank you, whoever sent it through, anonymous. What's the difference between cash and fixed income? Because that has come up quite a bit tonight, and there's a very important difference there, isn't there?
Yeah, so there you're talking about two investing asset classes where you're earning interest, but fundamentally they work quite differently. So cash really works a lot more like a term deposit, like a savings account that has an agreed rate of interest, and is typically, both are among, they're classified as income assets, and they're among the more safer defensive side of investing. In fixed interest, you have things like bonds, which are effectively a debt instrument, meaning that you are basically loaning money, often to a city or to a company or to in order to fund their operations. So fixed interest, primarily we're talking about bonds. Again, on Smart Investor, a lot of introductory material into this area of fixed interest if you're interested. And we're also publishing all the different bond offers that are available here in New Zealand.
Excellent. Now, is just checking in with everyone. Does anyone have a question, thoughts, feelings? Yes, go for it.
How do you make the variance more tangible? So, I think the research shows that a lot of people will believe that they're going to stick the market out, but when the day comes, they jump out. And we've talked a lot about average returns. You can look at the spiky graph, but how do you make that real so that when the day comes that you do have the steadfast?
Yeah, for those at home, excellent question. That was, how do you make sure that you are ready and prepared for when the inevitable dip comes? Because it does. People say they're ready, and then the dip comes and they panic and they're out, and that is the last thing you want to do. So
I'm going to say community, because I think on your own you can tend to make rash decisions. So if you don't have a friend that you can talk about money with, there's lots of people in this room that want to talk about money, so make friends, and then find your community. So there's tons of Facebook groups. Hatch has got one, and a lot of people, just put it out there. I'm feeling about this, and more experienced, confident investors will chime in, and there's lots of those groups. Can be Reddit, but find your community, because I think often that peer pressure in a positive way will give you the confidence to hold on.
One thing I could say is this is one of the reasons why we advocate goal-based investing, because if you have your goal in mind, the endpoint where you want to arrive to, what you're aiming to achieve with that money, not just getting rich in general, and then you can actually stick to your decisions a lot better. It might take you a little bit longer to get there or whatever, but you're using a product, you're using a vehicle to get where you need to go. I've actually seen the opposite happen, where somebody will set a goal and not stick to their goal, stay in the market longer, even when they've achieved their goal, and then end up taking a bath afterwards because they did not focus on it exactly the way. So if you think about, back to risk, a lot of people equate risk and volatility. If your goal is to achieve 4%, say you need 4% to hit your goal, whatever it is over time, and you choose to be in shares and they're fluctuating between, say, 10 and 7, right? And they're doing, just for the sake of an example, it doesn't matter what that volatility is doing. You are on track to your goal. So in that sense, when they say that shares are risky or spicier, they're not. They might not be. It depends what you're trying to achieve with them. So that's the one thing I'd say, to stay on track.
I guess adding to that, I probably didn't highlight it before. The other thing with goals is you do need to remember that question of when do you need the money, is it's actually a flexible point. Too often people put it down as a hard and fast line. I'm going to buy a house in 5 years' time. If in 5 years' time the markets are down, housing markets are not doing well, whatever it is, most people will probably have some flexibility with that goal and time frame. So you need to allow that. Maybe you can extend it by a year. Now, physically, on your point around how do you encourage good behaviour, it's a really big thing for us. And a lot of that comes down to building that community, putting good educational material out there. Equally, there are some things that technically we can do. So, for example, auto invest. The idea that you just set up your regular investment and you don't even look at it. Go back and carry on with your days and don't look at the headlines. The ironic thing is, as a tech company, we think you should only check the portfolio a couple of times a year, because the whole thing is, once you've set your investment strategy and what you want to do, you can put that into play. Don't look at it. That's hard because we know all of you just want to be on your phones 24/7 and want to see every single bit of information constantly. So things like auto invest can really help. At Kernel, the other thing that we do that may not be to everybody's taste, but we think it's a good behavioural practice, is we only allow people to trade once a week. So we are not an ETF, we are not reactionary, we don't allow you to buy or sell on a day's movement. We are there to try and encourage you to have that long-term thinking. And so, buying on a Monday or Tuesday, if you're investing for 10 years, that makes no difference. So there are technical things as well that you can do around the education to try and encourage the right behaviour. And if that's not your thing, then there are alternatives as well.
That's really cool, because I often think about the whole rise of the digital investing platforms as a double-edged sword. The easier you make it for people to invest, the bigger that door is for them to exit when they freak out. And often we think about investments as something external to us, but really it's actually more about us. And if we're trading all the time, if we're going to be exiting all the time, we're probably going to do it and get the timing wrong, right? So I think it's really important. That's one of the reasons why I think property should always be in the mix, because it's not liquid. It's not as liquid. It's not as easy to exit, and we're often the worst enemy. If we think we can pick stocks, we're probably dreaming, right? So I think that we need to be almost impaired in terms of taking that money out sometimes. So I didn't realize that you could take it out, that you couldn't do it more than once a week. I think that's cool.
Yeah, I would say I agree with so much of what's just been said there. I mean, the biggest thing is you're not supposed to look at it every day. There are some of the bank KiwiSavers will let you have your KiwiSaver balance right there next to all your other account balances, and that is dangerous because it's an investment portfolio and it will fluctuate and you will look at it every day and you'll get freaked out. I hate that idea. I don't look when it's gone bad, unless you really want to scratch that itch like picking a scab and you just want to have a little self-harm moment, but know that you're doing that. When it takes a turn, you shouldn't look. And I would say I'm also a member of some groups on Facebook of people who are really, and Instagram actually, it's fabulous. Surrounded myself with these people who are really interested in investing and property and paying off debt, and it has come up a lot over the last couple of days with coronavirus, with people saying, what do I do? And everyone commenting and saying, nothing. What is your long-term goal? And so those communities can be so helpful for talking you off the ledge when your emotions get the better of you, which they can.
I'm just sorry, I'm going to add one, because on Hatch I think you should look. I agree with the core, the boring stuff, set and forget, do all that. But look, if you want to empower yourself, I think coronavirus and looking at all the red, there's no better time to actually really evaluate why you picked that company and why you picked that exchange traded fund or whatever. Like, what is it that you're backing? And it's a fantastic learning opportunity. So use all those tips to not sell, but also use that looking in your portfolio as an educational experience and really reminding yourself of your goals, of why you're backing, why you back the success of that company, and empower yourself. Like, this is your money, so I'm all about looking.
It is probably important to point out that all of these things work together. I say this a lot. These aren't religions. You can have a bit of everything. It is part of a well-diversified portfolio. But it's understanding how much you put into each and personally what you're comfortable with and how much you want to play with, how much you want to just set and forget, and where property sits in, and all these other things. That's down to you. But these are just highlighting the different ways that you can go about growing your wealth and how they fit together as well.
All right, and an excellent question that's come through. Can you tell us about one of your own personal biggest investment wins? We're going to start from the other end this time. We're going to start from Darcy.
Sweet. Okay. Ooh, what do I tell you and what do I not tell you? I'm just trying to find a win in my mind here. So honestly, it's got to be property. A couple of minor interesting things apart from that, but really the property's been the most interesting thing because I was lucky enough 15 years ago to buy our first property with a 5% deposit, which is very, very fortunate. It's kind of like a very rare thing right now, so I'm aware that it's very difficult to do. We weren't fortunate enough to have family to give us any money to help us out, but we were fortunate to have a bank that, at the time, who allowed us to have a very small deposit. And that $13,700 deposit that we came up with 15 years ago, $2 million now. In terms of equity, because of the decisions that we subsequently make by using leverage and buying more property. So you could look at that two ways as, hey, I'm ruining New Zealanders' chance in buying properties, but ultimately I'm going to be answering to my kids, not you guys. So I don't care what the hell you think. But seriously, like, we all have that decision, right? Are you gonna do that and just do what's good for society? Maybe it's actually possible to do both. Maybe you could actually be a responsible investor and a responsible property investor, right? But I've done well, not because I was smart, but because I took risk when I was young, understood a few basics, but really I just didn't sell, and that was it.
Unfortunately, yes, buying my first home. That was pure luck, and again, fortunate that when that happened, it was at a time when you had a 5% deposit, and that was just fortuitous and the way the market was at the time. The biggest error I made was starting at NZX and working in index funds and not investing in index funds. Learned that lesson very well, and hence I'm here today. But yeah, so look, all these things come down to your personal situation, and you'll have different scenarios in your lives that throw up different situations, and some of you may have your own side hustles, you may have your own business. That's something that, obviously for me is a big thing that I'm really passionate about, so find your luck.
Yes, so for me it's been really just understanding what strategic asset allocation is about, finding mine, and actually investing. I'm probably more conservative than anybody on this because of my experience doing the GFC over in California, where everything started to go into a tailspin, and then moving here in 2008. But one of the advantages of having the right asset allocation for you is just that peace of mind and actually that ability to stay the course that we're talking about. And so in things like KiwiSaver, just having that set and put in, I think, is one of my biggest wins. Yeah.
2 for me, broken record, property, got in early and was able to benefit from that and just up the property ladder. The second is getting in the right. In Canada, we had a very similar thing to KiwiSaver, get in the right one. So if you don't know what you're in, check it tonight and get in the right one, because that could, make you hundreds of thousands in the future in the long run. And then the probably biggest loss, might be not getting in Tesla when it was $100, and when that got in and I didn't get in, and what are we at today? 8 something. So biggest financial loss. Anyway, KiwiSaver, property.
Yeah, and I would say that mine was just getting started. I mean, this is why I've changed my whole career based on this, because nobody told me what to do with money, and then I hit the stage where I really desperately needed to figure it out. And I started in shares. I think I was about a year into the podcast. It took me that long of talking to financial experts to build up the courage, and it was $20 a pop into, I think, the NZX 50, and then I tried out the US 500, and then I was like, this really isn't that hard, and I think I've got this. And I think it was more than anything else, it was the mindset, thank you. The mindset change that I did from that, like, yes, that was great for my personal finance future, but it was more than anything else, it was conquering the mental barriers. That was huge for me. Let's get political. When calculating retiring, would you still count on having the superannuation provided? Yeah, right? All right. I'm going to jump in before you, and then I want to hear what you have to say. Because I would say, in sight of the Beehive, I, in a former life, worked there as a journalist as well. And my 2 cents is that probably something should change with super. I doubt they would ever get rid of it entirely. But it is political poison to touch it. I would be shocked if they ever scrapped it. That said, I rely on nothing entirely. My plans include a paid-off home, so that at the very least I will always have shelter. It includes more than one form of income. It also includes super. And if one of those things fall over, the others should still cover me. Go for it.
Excellent. So I actually get this a lot in people planning for retirement and say, well, NZ Super is not going to be around. And people jump to that assumption right away. And I find that kind of odd, because when you start to look at the data, 60% of retirees today, it's their main source of income. That's what they live on. So again, to the political reality of that, most of those are, the voting public. And so it would be politically very, very dangerous in order to touch it. But at the same time, as you know, we've been working on at the Commission, we review retirement income policies every 3 years. You might not know that, but we look at the sustainability of the system. And in past years, it has been, somewhat obvious that, that it might change, that it might need some changes, that it might not be sustainable. The most recent review found that it is sustainable in its current form. The short answer is we don't know, because it's so connected to economic growth going forward. If there's a lot of economic growth, of course it's sustainable. Unsorted, on our retirement planner, we allow you to plan with NZ Super in the equation and without it. So you can have a look yourself. But whether on that assumption of it just won't be here for me, I have to depend on, we don't really agree. Doesn't really look that way.
So this one's for Darcy. You said you don't mind debt. What do you think is a safe mortgage to income ratio? And what can you say to convince us property is better than shares?
Oh, whoa.
Landmine!
Protect me from myself. Eh? So the first question was, how much is too much debt? More or less. I'm not going to answer the question around percentages, because I think it's kind of irrelevant, because the bank will stop you from actually getting into too much debt. Banks right now are actually quite conservative, so there is a built-in safety net where you're not technically going to get into too much debt, or else they would be acting irresponsible. But as a general theme, and going back to that whole kind of way that I generally work with a lot of people, is that I'll say what they need to hear, not necessarily something from a textbook or tips and tricks, which is what we're often used to reading. We're used to just seeing it in black and white. You should do this, therefore that's the answer. No, it's very, very specific. But as a general rule, you should get into as much debt as you possibly can. There, I said it. Okay, next question was what?
Can you convince us property is better than shares?
I probably could, maybe, on a good day. I'm not sure if I'm having a good day, but let's say that it isn't. What would you do? And it's not so much about the asset class, it's about the leverage, I think. And yes, the leverage has to be applied on an appropriate vehicle, or else you're going to get a lot of risk. But really, we're talking about leverage and time, and making sure that you've got enough income to be able to eventually kill that debt, or another plan on getting rid of that debt, like selling a property. Yeah, so there's no simple answer, and so I'm going to stay vague on that one. I'm sorry. I'm going to get in trouble. Anybody else want to say something on that one?
All right. Now, is there another question from the floor? Go for it.
It's not a problem I have, but it's a problem I have friends who have. What do you suggest for getting partners on board who just don't want to talk money?
Okay, for those watching at home, the question is, what do you suggest for when your partner doesn't want to talk about it? And I will jump into this a bit, and then I'll just see who wants to jump on that one afterwards. But I've done heaps on this because this is a super common question for people. Part of it is that thing where I said go back in time, go forward in time, and start with those abstract questions, because the problem with money is it ties into all of those sensitive, dark parts of ourselves. It's how much we're worth, it's how important we are, it's how powerful we are, it's what happened to us when we were a kid. I don't want to get all Freudian, but it is. And so if you are finding resistance from someone, it is hitting something there for them. So if you can go forwards and backwards, it takes the pressure off it. And then sometimes all you can do is lead by example. Sometimes all you can do is model your best life. That might entail a slight separation of finances. I don't want to tell anyone what to do. I would say that when I wasn't doing as well with money, my husband and I had totally separate finances. That was actually my call, because I didn't want him to see all the terrible things I was doing. I was being secretive. But you can achieve goals on your own. It's so much easier when your partner is on board. But hopefully, if you are modeling how much better it is, and life is better when you have control of your money, hopefully that will convince them through doing, and they might become more open to the conversation. But yeah, okay. Do you want me to go into the forwards backwards thing? Did everyone get that when I started? Like, I just really think if you start with your first money memories, those things that you talked about and your first experiences with money, and then if you start with, and then if you go from there into what would you do if you won lotto, and that's your future goals. That's right there, and those things can be key. Does anyone else have thoughts on that?
I'll answer it with a website, actually. It's called nowwearetalking.org.nz. And so last year during Money Week, which happened in September, we were thinking about this very problem. Is why do people have so many difficulties just talking about money? And we used to, when we used to talk about getting sorted too, we used to start with goals. But the reason why we don't start with that anymore is actually between partners, it's one of the most difficult things to do is set shared goals, and that's because of the conversation. It's so fraught. And so what we did was we put a lot of resources on that one site and just on starting the money conversation. And that includes prepping for it, what to do if it starts to go south, what to do if your partner reacts a certain way, so there's all sorts of things that we can do to have those conversations go a lot better. You can sort of understand why this would happen, because part of it is, if you think of partners, their money experiences will never be exactly the same. The amount of money they earn, it would be extremely rare that it would be exactly the same. Everything coming to that is just sort of different. But the good news is that if we can set shared goals, we can accomplish a lot more together in a partnership than maybe we would be able to on our own. And so they're definitely worth having. This is, communications about money is really the key to so much.
Okay, we've got one from Slido which says, is just having better returns than a savings account a reasonable goal? Or do you think about key milestones like house, retirement, etc. as actual goals? And I would say, better returns than a savings account. Yeah, you can do that. That is such a conservative goal, you can nail that. That is going to be great. But I would love to hear your thoughts on it, Kristen.
So it was, should I set...
Yeah, do you want a better return than a savings account?
do you need those key milestones like house retirement as actual goals?
Yeah, I would say actual goals. I mean, right now your returns on a savings account are like really bad. So it probably shouldn't be a goal. Savings is great for short-term money that you have, anything that you need in the next year or two, should probably be what your savings is. So if that's emergency fund, maybe that's a goal. So building up your emergency fund, done. Once you've got that, I would absolutely look at your next financial goal. That could be travel, could be a house, but again, it's looking at that timeline of how long do you have, and how much that money can grow in that time. So if you've got anything over 5 years, you probably are looking at that being in the share markets. And again, back to Dean's point of a house, if you're looking at buying a house in the next few years, controversial, but sitting in a savings account might not be the best place for it right now, because you may not buy a house in a few years. These things tend to shift. So once you've got your emergency fund, probably shouldn't have a lot of money sitting in a savings account right now.
All right, what about you, Dean?
No, great. And obviously, it's hard for short-term goals. And look, you guys are fortunate in the sense that, given the age and the topic of tonight, you are thinking long-term investment goals. The challenge is actually for those at the more retirement end of the spectrum. That's become a really difficult situation given how low interest rates are. That part of the market has historically really relied on the income from term deposits and on-call savings accounts and those more secure assets. They are having a really difficult time. So if you're in retirement now, you have to do some really hard thinking about how you are going to fund your retirement, because I think Tom talked about, there is a huge portion of the population that rely on super and rely on something to top up their income. And so now that interest rates, you get 0.1% on an on-call bank account at the moment, pre-tax, it's really hard. So you are seeing that part of the market have to look at things like they are investing more in, commercial property funds and high yielding stocks to try and find an income source. So you will have to continue to assess how comfortable you are with different risks, and to the point Chris, around that buying the house and maybe putting it into the market, if you've got a bit of flexibility around your time frame, that is an option.
All right, we've got another question that's come through. What's your favorite personal finance book? Mine. I wrote it because I thought it needed to be written. But no, all right, if I'm not going to plug myself, Your Money or Your Life is one of my favorites. It's an all-time classic. What about you guys? I will also let you throw in a website or a podcast.
No, I'm trying to forget. I'm literally reading it again at the moment. I can't remember the title of it. It's the 12-Step Recovery Program for Active Managers, or something along those lines. It's a great book. It's about $8 on Amazon, so I highly recommend it.
What's the punchline? Is it proactive management in the end?
I don't think so.
No. Mine's, believe it or not, Rich Dad, Poor Dad. It's pretty simple, right? Like, it's pretty... Surprise. It's pretty basic. It's kind of almost too basic. It's very American. But I gotta be honest, right? I've read a few books, but that's probably the best, I'm being honest.
There's one I like that I'm reading right now, and it's actually Canadian, actually. And it's called Worry-Free Money. And I really like that. Shannon Lee Jones, I think her last name. So I'll just mention that one. Yeah, there's so much. I'm really interested in the psychology of money, and one of the most fulfilling things is actually seeing people's levels of anxiety drop. But she actually does a really good job of understanding how to get past a lot of things.
I'm probably more of a blog reader, actually. I subscribe to a few, but one that I love is Elevest. For any women out there, I definitely recommend subscribing to that one. I don't really like any of the Barefoot Investors or Rich Dad, Poor Dad. I just find it kind of generic or I don't know. But I do find really relevant. Like Elevest is like, get that next raise. Like you either have to save money or earn more money, and when you earn more money, you can do more interesting things with it. So I love blogs for that, because I just feel they're a little bit more timely and action oriented and relevant to me.
All right, great. Well, we are coming up to the end, so I'm going to combine a couple of questions here. So this one's for you, Dean. although I would also be interested in your thoughts, Kristen, afterwards. How do you see the tax structure for international funds shaping up? So I guess, is tax really a problem? Is more a simpler way of putting that? But also, you know, can you work with more international funds like Vanguard? Can you get closer with them?
Yeah, look, really great question for the last thing, one of the last ones to wrap up with. International tax is a big topic. It's not something we can summarise in a couple of minutes, and it's not something that we can give tax advice on. Kristen, we spoke about at the last event, it does get very complex as soon as you start to invest over sort of that $50,000 threshold. It is something, probably just lightning that, and I think happy for you guys to reach out to us and we can talk about different tax structures and how they work with different funds, but that's a big topic. The key thing though is that this is one of those things that you do need to do your research on. It comes back to my point earlier about fees. You may think that you're buying something that looks really cheap. It may have a low management fee, but tax may be eroding all of that benefit, and it may be actually more expensive than something that has a higher fee and is in a different market or a different structure. So look at all those details. Unfortunately, with international tax, there is no right or wrong answer. You know, there is the idea that you could invest through a New Zealand-based fund that is investing in international markets, or you could buy shares or funds offshore. There is no pure yes, no correct answer around tax. It comes down to a number of assumptions around your personal situation, how much you're investing, and how much you think the market's going to return over time, because that actually, you've got a couple of different methodologies for how the tax can be calculated. So that's where the complexity comes in, and that's where, unfortunately, it's one of those things that we can't just say, this is the best answer. But do reach out and have to kind of give you some guidance or direction to where you can find more information on what you should be considering.
I'd echo that. Under 50K, really simple. If you're investing through Hatch, we sort all that for you and you get your number and put it in your return. But I'd just like to iterate that every fund, be it onshore or offshore, pays tax. Everybody pays tax. So if it's wrapped in a pie or not, you're paying tax somehow. It's either on your behalf or you're doing it yourself. So I think probably most platforms nowadays make it super simple. Like we said, under 50K, easy, no worries. Over 50, can be also pretty easy. 2 ways of calculating international tax. We try and make that simple. We also partner with a fantastic company called ShareSite that can also make that quite simple. So depending on your scenarios, it can actually be advantageous not to invest in a pie fund, which is kind of the wrapper that they put in New Zealand funds here and add fees in. So it can be, but depending on your situation and how often you're investing and so on and so forth. So do your reading. There's some great Reddit posts about it as well.
All right, we're coming up close to the end, so if you have a question on your mind, now is the time. All right, at the back.
Sorry, so the US 500 ETF on smart shares, does that equate to that 50K group, including your Hatch?
No, that's wrapped in a pie. So smart shares funds are wrapped in a pie. And you'll see that if you compare the fees of a smart shares fund versus going direct to a 500, you'll see the difference in the expense ratio.
So interestingly on that fund pays tax, as Chris said, everybody, you can't get around the tax. Pie funds are forced to calculate that international tax under what's called the FDR rule. So there's 2 methods, FDR, CV, you can talk about that later, but that basically means the fund pays tax on 5% of the value of the portfolio flat. And it's doing that at that tax rate, which is 28% in that fund. So again, there's a lot of hidden things. Then there's withholding tax, which I think you guys filed the W8 BEN forms. So if you don't do W8 BEN forms, you'd be withholding tax of 30% when investing in the US. If you do, it's 15%. So it's a minefield, but there are resources, and but it's a hard one to talk about in this sort of setting.
So the other question is, from a Hatch and Kernel, so for individual investors, what's your maximum insurance protection for an investment portfolio? So how much, like in Hatch scenario, so how much does drive down, or how much does it cover? Is it 500K or is it?
So for each individual account's protected. Yeah, so to repeat the question, it's how much is your account insured for in the event of failure. So obviously market losses, you're not insured. That's just the way the world rolls. But in terms of if a broker were to go under, you would be, now naturally you are the owner of shares, so that money would flow back to you. Or your shares would just be transferred to another broker. So you own the underlying shares. Now, if there was fraud and that money was stolen from you, you are insured by US regulations under legislation that came into play after the GFC. You're insured for up to $500,000 US dollars in your account.
That's for hedge.
Yeah.
And what about you guys?
Yeah, perfect. So we're a New Zealand fund manager. We're licensed by the Financial Markets Authority, and so this applies to pretty much every single retail fund in New Zealand that has a product disclosure statement or a PDS. Everything is very standardised and operates under the legislation. We have what's called a master trustee. That's the document that governs how those funds are run. Each one is its own entity and it has its own assets. So the shares in that fund sit in that fund. They're not connected to us as Kernel, the entity. We can't access them. The other party that comes into play there is the independent custodian. So the assets are held by the independent custodian, fully separate to us as Kernel. Finally, the other big thing that kind of comes into play there is we have what's called a supervisor, used to be called a trustee. They are there, every fund manager has to have one. They are there to act in your best interest. They are licensed also by the FMA, and they report back and they monitor our activities. You have monthly reporting, quarterly meetings, and they're there to, I guess, ensure on a day-to-day basis that what you're doing complies with the document, the trust deed, that you're doing what you say you're going to do in the PDS, and that everything is above board and carrying on as normal. So they're kind of the feet on the ground for the FMA, I guess you could say. So you have a number of protections in place. If any one of those things fell apart, like if Kernel, the entity, or any fund manager failed as a company, the supervisor would step in and they would either appoint another manager or they would wind up the fund and sell the assets and give it back. So really the inconvenience there is potentially a time issue. That's sort of the way the model works. The legislation in New Zealand is fantastic. The way the regulator works is fantastic, and it's really standardised now. We've got a standardised product disclosure statement that's plain English and everybody can read. Most master trustees that how the funds operate under are very standardised now as well. So the system has, over the years, had a lot of changes to it that really are now making a lot of benefit to you guys as investors in terms of protection.
All right, is there one last question from the floor? Anyone? Ooh, go on.
So since we're on this subject of staying safe while investing, I have the privilege at Sorted to manage a fraud investigator. And this person, Bronwyn Groot, she basically looks into investment fraud. And out of her casework, we spin off a lot of education on trying to keep people safe. So I get a front row seat and watching, unfortunately, people lose hundreds of thousands of dollars. And this happens on a routine basis because here in New Zealand, we are targets for investment scams and frauds. And I know a lot of us in this room will consider us way too clever to ever fall for that sort of thing. But what we've discovered in terms of victims is it's not how clever you are, it's not a personality profile, it's actually what you're going through at the time. And so people get vulnerable when they go through stuff. If your pet dies, if you lose a partner, if you lose a job, anything you're going through can actually make you vulnerable to an investment fraud. And so there's high levels of social engineering going on here. And the things, basically, it's a wild west online these days. We're in an environment where not just investment opportunities can be faked, not just investment companies can be faked, but entire government regulators can be faked. And I've seen it online just to prove that an investment opportunity is legit. So you go and do your due diligence after you get this offer, maybe cold call on the phone, and you find out that it's legit, but that whole website, the whole entity has only been invented, has only been brought online in the past week. So I invite you to really stay safe out there, look out for each other. The anecdote to that is really community and actually staying close to each other, especially when we're going through stuff. So if you could just pass that on, I think we can all be a lot safer as we invest here in New Zealand. Cheers.
Yeah, I would also say I did some court reporting for a while as well, and you see really smart business leaders who are in court as the victim of fraud. No one is too smart to get sucked in, and it is exactly what you say of checking everything. And also, when you mentioned about the cold calls, I don't trust anyone who cold calls. I don't want to know about it. Well, exactly. So, what are common investing mistakes on that note, and how do I avoid them? And I guess kind of feeding into that, my point of view on that would be emotion is your worst enemy. You can get sucked into wanting to get rich quick, or you can get sucked into thinking the sky is falling, and your way to avoid it is exactly what you're doing now. The fact that you are here and educating yourselves and figuring out what you want to do and asking questions and meeting other people who are also interested in it, those are your protections. And also never thinking you're above being scammed, always keeping an eagle eye out. That would be my points. What about you, Kristen?
Get started, start building your wealth sooner rather than later. Emotions, obviously, keep those in check, and invest in yourself and financial literacy. Really empower yourself. The amount that you calculated in your heads or on your phone, that's yours, that's your value. So really think about what you're going to do with that.
To me, it's a lot about criteria. Stick to your criteria when you pick. I see it a lot with KiwiSaver funds. People are picking, their KiwiSaver fund because they're going to a familiar brand, or because they have the ability to see it on their phone, or because they heard it. But stick to your criteria, the right risk level for you, fees that are reasonable, services that a fund manager offers you, and beware of people who claim that they can tell the future. That's really, a lot of people you'll see it a lot of people falling over themselves trying to call the top of the market, they really don't know, they just want bragging rights, so the person who actually gets it right is going to be able to say, yeah, I called it. They don't know. Nobody can really tell the future. So when you know that, then you can make choices accordingly.
Obviously on that, for us, a big part of what we're trying to do is still, it's a bit of a downer, but educate people that 30% last year is not what you should expect every year. So just have realistic expectations and think long term, and don't try and change your strategy because you only made 5% this year. Who knows what the market's going to do. The other big thing, just probably touching on probably the very first point of the night around budgeting and setting up your investment strategy. If you're starting out, or you're thinking about how much you contribute every month or week or whatever it may be, just be realistic with yourself and start small. We probably didn't touch that at the start, but it's just like setting a New Year's resolution and saying, I'm going to go to the gym 5 days a week. If you set that bar too high too early, odds are you aren't going to go to the gym 5 days a week, and you will fail, and then you'll probably just give up completely. So just start small and build up as you become more comfortable, as you find that yes, you can live with a little bit less, and then just increase your investments or savings or whatever it may be on the side. So don't be afraid of just starting with that small amount and growing from there.
So the biggest mistake, is that right? The biggest mistake you can make? I always forget because it takes 3 to get to me, and I forget the question by the time it gets here. But that's right. I'll just keep saying my name. But the biggest, I'll rephrase it. The biggest risk that people often make when investing of any sort, that I've observed anyway, is not involving others in their decision. It's kind of going it alone. It's not that you're not capable of making a good decision on your own, not at all, but you don't know. And inviting somebody else, if you don't have a partner, you need to find someone that you can talk openly about money with. But just sounding out an idea before you do it, it's just a good safety check. I guess speaking to scams as well, that's a really good safety check. But also, you might be drinking too much coffee that day. You might not be seeing things clearly. You might be making an emotional decision, whether to sell out of a fund or to get into something, buy a property off the plans in Auckland, heaven forbid. All that sort of stuff. Those are things that sometimes emotion can get wound up in your own head. And so it's a bit of a shameless plug to go talk to an advisor as well. Because an advisor is that. Often we kind of assume that a financial advisor, whether it's a mortgage or even investment advisor, they're there to help me pick stocks. That's not at all what they're for. One of their primary functions, apart from sometimes marriage counseling, is that they can actually just keep you accountable and be that independent ear, so that you at least have had some input from someone else. You don't have to follow their recommendation, but just the act of actually talking to somebody else is really important. It de-risks things a whole lot. It's like a cooling off period, you know? Otherwise, it's just financial masturbation. Cool? Did he say that?
I love it. You just wanted to say that for the reaction. All right, we have just a few minutes left, so I'm just going to go down and I'm just going to say super quick in a nutshell for all of you. What was a moment when you had a bit of a financial light bulb where you realized something, or you changed your mind on something, or you figured something out that in the past you would have never thought you could have done? What's been yours? Let's start with you.
Why start with him?
Well, we can say Darcy. He did just say masturbation.
You know, I won't do that one. That was too rough last time. I was once making, I think, $400 a week, and that was, I knew that's what I was going to make for the entire year. That was my income, my net income. And at the start of the year, a father of one of the friends caught up with a group of us and talked to us about budgeting. I think he was an accountant, I can't quite remember, but he talked to us about budgeting. I had actually never heard about this, and I had done a degree in finance and all the rest of it. I'd never actually heard any actual wisdom around personal finance until that guy talked to us about how to do a budget. And that was, seriously, it was life-changing. I had only $400 a week. I knew I had to spend $150 a week on board, or rent, at the time, and all these other expenses. That lesson that I learned during that year was so powerful, because what I do now is I can link it back to that. You know, this resource that goes through my fingers, the money that goes through my fingers, I can actually kind of control where it goes. It sounds simple, but that's actually quite mind-blowing. And unless you go through some sort of experience, some sort of transformation, you know, you'll be passive, right? So it's quite important, I think, to have that wake-up moment. And for me, it was simple, but that was it.
Big light bulb moment.
I know, that's a hard one.
That's cheating.
Well, it's a little bit related to what Darcy said, just how intentional our money lives it can be. So that paying yourself first thing that I keep going on about is really what makes so many things in the money world work, whether it is tax, KiwiSaver, and all. And why not just do that for ourselves? That was a key thing for me. The other thing is, traditionally, you know, I had made a lot of money, spent a lot of money, made a lot of money, spent a lot of money, and just that whole thing. What I am after, especially when I teach my kids about it, is that one portion of your finances, and as much as possible, actually, because your needs over time are going to go up, needs to be always growing. So if I was going to ask them, hey, what's money for? I would hope to get to the place where we could say, hey, money is for growing.
I can't think of a light bulb moment, but I just sort of highlight, probably given the theme of tonight, probably very fortunate growing up that I had parents and family that were very open about money. So we were all very open talking about income and how much we earned and what we were doing and running businesses. So I guess the key message to all of you is, when you have children or you have friends, is to have those conversations, because that's the biggest thing about all of tonight is we need to grow financial literacy in New Zealand generally, and that starts actually with you as individuals talking more openly about, you know, how much you are earning, how much you're paying on your debt and investing, and sharing those experiences together. A little plug, Kat and I are leaving in a matter of minutes because we are catching a flight back to Auckland, so we won't be sticking around at the end, but do feel free to get in touch if you have any questions after the event.
Quickly, for me, was getting paid what I was worth. I always looked at those early jobs as like learning experiences. Just get paid what you're worth. So if you're not feeling super jazzed and valued, ask for a raise tomorrow. Secondly is make money while you sleep. So think of all the ways that you can make money while you sleep. So not in you're just getting paid while you work, but having your money work for you.
I love it. All right, well, on that note, because there are flights to catch, thank you so much to Hatch and Kernel for putting this on, to Kiwi Wealth for having us, and to you guys for having awesome questions and very patient listening faces. This has been great. Thank you all so much.